Hello guys, in this video we'll talk about the application of the perpetual dividend discount model. As we know that this model can only be applied obviously on the firms which are paying dividends, plus these are stable firms in the sense that uh, the dividend paying history and the growth of the dividend is stable for such firms. For example, Walmart, Costco, they are paying stable dividends over the period of time. So we have these learning objectives. We will apply the perpetual dividend discount model on a real fund, and I'm choosing Walmart for this purpose. And then we'll see that how we can compute the variables which are used in the dividend discount model, perpetual dividend discount model, and how we can gather these information from Yahoo Finance and the Value Line investment survey reports. So first of all, what is dividend discount model? And the dividend discount model price is based on this premises that the price of an asset depends on the future value which is generated by, or future cash flows which is generated by the asset. If we'll discount the future value of these cash flows which asset is generating and find their present value, and that present sum of the present value of all these future values basically give us the price of the asset. So the same thing applies on the stock as well. The cash flow related to the stock is the dividend. So if we'll uh, guess the future dividends and find their present value, add those present value together, we'll get the price of the stock. Now the company is considered a going concern, so it might remain there for 200 year, 300 year, 400 year, and might be for the rest of the life until we have the end of the world. So how we can be able to find the present value of all these infinite dividends? It's almost very much impossible. But the good thing is this, that if we make a simple assumption that will be a perpetual growth of the dividends into the future, the everything is summed up into a simple formula, and this formula is written over here. You can see that this is the formula written over here, right? So that the present value of the stock is based upon the next dividend divided by the RS, which is the required rate of return of the stock, minus the growth of the dividend. Now D1 can be found if we have a current dividend D0 multiplied by 1 plus the growth rate, right? And one limitation is this, that the required rate of return should be greater than the growth of the dividend. Now the time has come to find out how we can find the values of these input variables. So RS is the required rate of return, and we can use capital asset pricing model for that. The growth of the dividend, we'll simply see that how the dividend has been growing over the period of time in the last 4 or 5 years, especially like normally the 5 years. The analysts do this calculation, and D0 is very easy. It's the recent dividend get paid, right? So we can use this dividend discount model on the Walmart, and the information we can gather from many sources. For example, Value Line investment survey reports and the Yahoo Finance. So these three variables are important to use in order to find the present value of the stock using the perpetual dividend growth model. Again, the big assumption is this, that the company is stable, it has been paying dividend, and the growth of the dividend has been stable over the period of time. You can see that they have been growing like at some stable rate, right? So this is a big assumption which we are going to make. That's why you cannot make such an assumption easily for a new company who does not have enough history from where we can basically interpret that this company is stable in terms of paying the dividends, or the growth of the dividends has been stable over the period of time. So we have to find these variables. So let's start with the required rate of return. Again, we use the capital asset pricing model. It's not CAM, it's actually the CAPM, right? So it's not CAP. This is actually the CAPM, capital asset pricing model. Capital asset pricing model, not the CAMP. It's a typo. Okay, so we can get the required rate of return by adding the risk-free rate plus the risk premium for investing in the risky stock. Again, the equities are risky, so there is a risk involved, and the formula can be expanded at risk-free rate plus the beta of the Walmart or of any company, but because we are talking about the Walmart over here, so we will be doing the calculation for the Walmart multiply with the market risk premium. So the risk-free rate of return we can gather from the Treasury website. So I have an Excel file in which I've also having the link, and this is the link over here. So treasury.gov, if you go to the resource center and then the data chart center, eventually you'll get the interest rate. So simply try to Google it and you will find it. You will find this link directly, that what is the rates on the like the treasury rates, and you'll get very easily from the Google. So if I'll click it, it is opening a web page, and here you go. We have all this thing, and because I'm recording this video on early morning on the 16th July, we can use this 3-month rate. 3-month rate is considered as a risk-free rate, and 3 months treasury rate, and the rate is, you can see that 0.16%. This is not like in decimal, like where you can say it's 16%. No, like right now 16% is a huge rate, right? So it's actually in terms of percentage. So 0.16% is the treasury rate today. So we can use that, and then we have like the beta into the market risk premium. Now the beta is depends on what data you have used to calculate the beta. The beta is simply the volatility, that how volatile is your stock to the volatility, how sensitive it is to the volatility of the return of the market index, right? So if the markets are moving up, whether your stocks are moving much more, or if the markets are moving down, whether the stock then the return on the stock is declining at a much faster pace. So the market beta is 1 when you compare the return of the market versus the return of the market on the x-axis and y-axis. Obviously you will get the 1, the slope will be 1. Whatever is the movement on the x-axis, the same is the movement on the y-axis, so it's 1. And the stock beta is calculated when you plot on the y-axis the return on the stock versus the return on the market. So if it is more than 1, then the stock is very risky. It means when the market is moving, if the beta is 1.32%, it's not in percentage, it's in simple numbers. If it is 1.32, then we can interpret that if the market return if the market increased by 1%, the stock is increasing by 1.32%. So it's more sensitive to the market. And likewise, if the return decreases of the market by 1%, the stock with the beta of 1.32 suggests that the return on the stock will decrease by 1.32%. It's more volatile compared to the market, and it's very sensitive to the market volatility. So that beta we can gather from, we can also calculate, but under the summary tab. Under the summary tab, we can see that this is the beta is 0.3, and again the beta is sensitive to the data which we are using to calculate the beta. So what returns we are using? Are we using the daily returns, weekly returns, and then for how many years? For example, over here the Yahoo is using the monthly returns for the last 5 years, and they calculated the beta of 0.3. They have calculated 0.3. Now, if we'll go to the value line investment reports for the Walmart, and we open it up, the beta over here is 0.75, right? So they might have used, in fact, they definitely have used different data. They might have used the daily return for the last 3 years or for the last 1 year, right? So the beta is 0.75. Now, what I'm doing, I'm just taking the average of these two betas. I'm taking the Yahoo Finance beta, which is 0.3, and adding 0.75 the beta from the value line and dividing it by 2. So I ended up getting the average of how much I got. This beta over here, 0.525, simply 0.75 plus 0.3 divided by 2. Multiply by this market risk premium, 7%. 7%. So there was a survey happened, and the economist 226 economists participated in that survey. So the median response that the future next 10 to 15 in next 10 to 15 years the market premium will be around 7%. So I'm using that service value and considering 7%. So you can do also in your calculation while calculating the required rate of return of any stock, you can use 7% as a market risk premium, and then multiply with the beta of that stock to get the risk premium on that stock, right? So if you now do this calculation, 0.16 plus 0.525 multiplied by 7%, you can see that the return, required rate of return on the Walmart stock is 3.835%, right? Now this is the first variable which we got for the dividend, perpetual dividend discount model. What is the second variable, right? The growth rate. That's very important. One way is to find the sustainable growth rate. Sustainable growth rate. So the sustainable growth rate is the given from the formula of return on equity multiplied by the retention ratio, where retention ratio is equal to 1 minus the payout ratio. So this formula over here, right? This one. So ROE, the return on equity, I am right now using the values from the Value Line Investment Survey. So my return on equity is 18.9%, right? And how I know that my return on equity is 18.9%? So you can see this is my return on equity, and 2019 year is yet completed. 2020 is not yet completed. So under the column of 2020, the value line has made their estimates. So these are just the estimates at this time, but not the real data. But we want to use the actual historical data. So for 2019, the historical data suggests that the return on equity is this one, 18.9%. So I'm using simply that 18.9% over here, right? Multiply by 1 minus the payout ratio. So in order to find the payout ratio, actually I'm doing the average payout ratio of the last 5 years, just in order to remain confident that this is the average payout ratio, by which the dividends are, or the earnings are distributed among the shareholders of the Walmart. So that payout ratio I can get from the value line again over here. So 2019, this one, this is all dividend to net profit, which is actually the payout ratio. 43%, 42% for 2018, 46% for 2017. You can see that 43% for 46% for 2016 as well, 43% for 2015. So you can use the 5 years data, 19, 18, 17, 16, 15, right? Even the 2014 is highlighted, but you can leave that. So 5 years of data, add them together and divide it by 5, right? So if I'll do that, I got actually the 44%. So this is over here. In decimal, 44% is 0.44. If I do this calculation, I ended up getting the growth rate of 10.58%. So can we apply dividend discount model? Using the sustainable growth rate, we cannot apply the dividend discount model, right? Because in order to apply the perpetual dividend discount model, our growth rate should be less than your required rate of return on the Walmart stock. So over here, RS is not greater than growth. In fact, growth is greater than your required rate of return on the Walmart stock. So if that happens, we cannot apply. So we need to find some, other ways to find the dividend, right? The growth of the dividend. So if you see, I actually gathered the data, the actual data on the dividend of the Walmart stock, which is in 2019 they paid 2.12, in 2018 they paid 2.08, in 2017 they paid 2.04, in 2016 they paid, actually not, this is 3.2. This is not the situation. Actually they paid $2 only. $2. This is wrong. $2, right? $2. In 2015 they paid 1.96. 2014 they paid 1.92. Okay, I used 6 years of data in order to get 5 growths, right? When there is a growth rate, you need, if you need 5 growth rates, then you need 6 data points in order to find 5 growths, right? So this is how I found, and you can find that the growth rate is 2%, right? And how did I find that? So simply, in order to find the growth of 2019, you have to subtract the dividend of 2018 from 2019 and divide it by the dividend of 2018, like what I am doing over here. So this will give you the growth rate of 2019, 1.92%, right? So this is this. Now, in the same way, find the growth rate of the dividend for 2018, 17, 16, and 15, right? And if you'll do that, these are the growth rate for these respective years. Now add all of these growth rate, these are 5 growth rate, and divide it by 5, you'll get the average growth rate of 2%. Now there is another way to find the geometric growth, and many analysts actually do find simply the growth rate of the dividend using the geometric growth rate model or formula. So they are dividing the last dividend, which is the 2019 dividend, divided by the 2014, the oldest dividend, because we are considering 6 data points, right? And 6 data points will give us 5 growth rate. So 2019 dividend in this case for the Walmart divided by the 2014 dividend for the Walmart, and raised to the power 1 divided by n, where n is the number of growths. So there are 5 growths, right? Minus 1. If you do this calculation, I will again end up getting 2%. So both average growth formula and the geometric growth formula is suggesting that 2% is the growth rate of the dividend of Walmart. So we will be using that. So how can we use this now in the formula? The same thing. The recent dividend 2.12 multiplied by 1 plus the growth rate of the dividend, which we are taking as a 2%, divided by required rate of return, which is 3.835%. In decimal, it's 0.03835 minus the growth rate of the dividend, 0.02. If we'll do this calculation, we'll find that the price of the Walmart stock is $117.82. Yesterday night, it closed at 132. So again, the Walmart is actually at this time, according to this model, is an overvalued stock, right? So our model suggesting that its price should be 117.84. But you might have considered over here that the data matters a lot. With beta you are using, what different things like input variable for the growth you are using, that matters a lot in order to find this thing. So it all comes to the point where you are confident about your assumptions. And how you will be confident about your assumptions? If you are studying the industry well, if you are studying the economy well, these at the high level, and obviously then your company well as well, you are studying the company thoroughly as well. So this is the snapshot of the value line surveys, which I have taken from here, the report. This is the snapshot of the value line survey reports. So these are very important. Many analysts use these reports to find to gather the data, like what we have done to find the growth rate. Now, what if you do not have the value line survey reports? For example, over here, dividend declared, we have seen that we use the value of the dividends in this. Actually, I used Excel file because that makes the calculation much easy, right? So when I use the Excel file, I simply, you can see that input all these dividend and see how they are growing and took its average. Likewise, I use the formula in the Excel to find the geometric growth of the dividend over here. Now, from where this data came? Again, value line investment report is very handy if you have that in your hand, because everything is just on one page. This is the good thing about the value line. All the data which you need to analyze or finding analyze a equity or stock and finding the price of the stock is on one page, right? So on the value line, this is over here, the dividend declared. You can see this one. Can you see 2.12, 2.02, 08, 2.24, 1.96, 1.92. All these data is simply feed over here. Now, what if you do not have a value line? One thing is there, you need to search on Google, obviously. For example, I searched on Google and found on the Guru Focus that during the 5 year, the average dividend per share growth rate was 2%. Well, here we have the data, right? I can use simply that 2%, but I cannot, I can simply plug in that 2% in the formula, but I cannot show that what was actually the dividend. Now, if some person, if you are very, choosy, you want to do your own analysis, you are not trusting any source like this, right? Then you have to go to the Security and Exchange Commission website and check the annual reports of the Walmart. For example, simply type SEC, and the first link, if you type SEC and search, this is what you will get, right? This page. You open it up and give the ticker of the Walmart. It's taking some time. I'm recording at the same time. I think my computer is a bit slow handling both queries at the same time. So I'll go into the ticker. This is the Security and Exchange Commission website, where all these publicly listed firms are obligated to upload their reports, annual reports. So I will write WMT, which is the Walmart. You can see that Walmart, and now I'm I press the search button. Now let's wait for the next page to open. Now all these reports are filed by the Walmart. What I'm actually looking for is 10K annual report, 10K, 10-K, right? Because there is so much other reporting as well they have to do. But I'm very much like I need the specific information. Let's suppose if you need the dividend, you do not have a value line investment reports, then I will go into the 10K. Again, I have to wait. After 10-K, I pressed enter. And here you go. I have the first 10K. So that was filed on the 20th of March 2020, right? And this the fiscal year of the Walmart closes on 31st January every year. So this is the annual report of the 31st January, but it filed in 20th March 2020. And I press the document, and this will open up the annual report of the Walmart for the last year. This first link, 10K, sorry, I still have to press this button. I have to click this link. It's loading. So this form, annual form, means annual statement, is getting opened. We simply have to wait because there might be a lot of data. And once it is open, we have to go specifically to the item number 8. In item number 8 of the annual report, we will have the dividend payments, history of the dividend payments, and we can get that information from there. It is taking some time. So here you go. There you go. We have the annual statement of the Walmart, and we have to go to the item number 8. This is item number 8. Once we click the item number 8, it will take us to the annual statements. And this is here you go. Dividend declared per common share 2.12, 2.08, 2.04. So even if you do not have a value line investment report, you can still go and dig out that what is the dividend which the Walmart has paid, right? So you can use that in your Excel file and simply get what is the growth rate of the dividend of the Walmart stock, right? So this is how you'll find the growth. CAPM is very easy. I told you how to go. You have to go onto the trade link, get the risk-free rate of return. Beta you can get either from Value Line or you can get from the Yahoo Finance website. So in Yahoo Finance website, under the summary tab, you have the beta. And if you see this thing over here, guys, under the Yahoo Finance, this summary tab, this is the beta over here, this one, right? So you can easily get the beta. Now, like there was return on equity as well, which we have used while finding the sustainable growth and the payout ratio. Those are given under the statistics tab. So if you will click on the statistics tab, so over here you have all the payout ratios. Simply Control F, payout ratio, and it will take you to the payout ratio over here, right? So this is the payout ratio. Either you can use this, or either you can use if you have the value line investment reward. But if you don't have, you can still go to the Yahoo Finance. So in the Excel file, like I just put the notations. For example, this is while doing the required rate of return calculation. I know beta I can get from the Yahoo Finance. I can also get the beta from the value line. I actually used in my calculation, if you remember, the average of both of them, because beta is very sensitive to what periodic returns we are taking up. Either we are taking monthly returns, either we are taking daily returns. Usually it is suggested that the monthly return for for the 5 years is enough, or the weekly return for 1 year, weekly return for 3 years, or daily return of 1 year should be used. So again, monthly returns for 5 years, weekly return for 3 years, or daily returns for 1 year. Some people calculate the beta based on all these three ways, in these three ways, and simply take their average. So it's time consuming. If you are started spending so much time on one company, like you might not be able to do again, you have to analyze that what is your marginal benefit given your marginal cost. If the marginal benefit is fine, it's more than that, then yes, go and do so much calculation. Otherwise, you have Yahoo Finance, you have Value Line Investment Survey, so get the beta from there. And if you do not have the Value Line Investment Survey reports, because you need to get the subscription for that, then you can still use the Yahoo Finance. But because I have the data from both of them, so I'm using both the average of the beta of both reported by both by Yahoo Finance and the Value Line Investment Report. So 0.3 plus 0.75 divided by 2, this beta I've used over here. So we can see that my required rate of return is this, and this is the stock price of Walmart according to this model. So I'm quickly wrapping it up now. We have seen that how we can apply a perpetual dividend discount model on a real firm, which is the Walmart in this case, and we have also seen that how we can calculate